Hey everyone, welcome to another episode of The Remote Real Estate Investor. I'm Michael Albom, and today I'm joined by Richard Vague, who serves as the Pennsylvania Secretary of Banking and Securities. And he's going to be talking to us today about debt in the American household. So let's get into it. Hey Richard, thank you so much for coming on and chatting with me today. I really appreciate you taking the time.
Well, it's a real privilege. You guys have a great show, and I'm honored to be on it.
Oh, thank you. I appreciate that. So we are here today to talk about something that I think is on every real estate investor's mind, and well, most real estate investors' mind, and that's debt. And you've got a really unique position to be able to talk about debt. So for anyone who doesn't know who you are, where you come from, and what your background is, if you can give us a quick intro, a quick insider's peek into what those things are.
Well, I was in the banking industry forever and ever, which included, some amount of mortgage lending, a lot of consumer lending. I spent about the last 10 years in venture capital, which obviously includes more equity than debt, but includes both. But kind of as an outgrowth of the Great Recession of a decade plus ago, I've written a series of books, including The Next Economic Disaster and A Brief History of Doom, and more recently, The Case for a Debt Jubilee, that really get deeply into debt and both the positive and negative aspects of debt. So it's a topic that remains heavy on my mind.
It sure sounds like it. And for anyone interested, where could they find that book?
Well, if you go to my own website, which is richardvague.com, and Vague is spelled V as in Victor, Ague, you can see all those books.
Okay, fantastic. So let's dive right in. And I'm curious, Richard, in your opinion, how and why is debt such an issue in the States, in this country?
Well, over the course of pretty much my own lifetime, certainly the last couple of generations, let's call it World War II forward, household debt has tripled. In 1950-ish, household debt, if expressed as a percent of GDP, was about 50%, and today it's about 160%. So there's a lot of it around, and a lot of households, have accumulated debt of several types, so that they're really struggling. We see households that have a mortgage, perhaps even a second mortgage. They have student debt of their kids. They may even have some residual student debt of their own. They may have had a surprise medical bill that they had to finance through debt. So you see folks with this kind of unhappy portfolio of debt that's really weighing them down and affecting their lives quite significantly.
Yeah. Okay. And as investors, we joke is the wrong word because it's no joking matter, but talk about good debt versus bad debt. And would you agree that there is such a discrepancy between the two, or such a difference between the two?
Absolutely. In fact, I'm writing a book right now called The Paradox of Debt, which gets to that very issue, because debt is necessary. Economies absolutely couldn't function at all without debt. That includes, your local retail store, the inventory they have in their stores, done on a debt line of credit. The grocery store that you go to, their shelves are stocked by debt. Folks buying their homes, which I know is a near and dear subject for you guys, couldn't really achieve that without debt. So there's any number of things that are necessary and positive about debt, but then there's the other side. Normally when debt accumulates too rapidly or gets too high, it has all sorts of effects that are in the other direction.
Okay. And how do you make that distinguishment? If someone listening is thinking about scaling the real estate portfolio and plans to go get a ton of debt really quickly, they could be hearing what you're saying and think, oh, maybe I need to pump the brakes. So how do you distinguish between the good debt and the bad debt, or maybe what's too rapid versus too slow?
Well, I'd make a distinction between how I measure it for a country, which I spend a lot of time doing, and how I would measure it for an individual.
Okay.
I think the real issues for an individual relate to how much leverage you have on a particular property. If you're leveraging properties at 100% or 95%, as many folks were doing here a decade or so ago, you need to have really thought it through carefully. And if you have several properties like that, I mean, my own expectation is that here over the next couple of years, we're going to have a real flattening of valuations of real estate. Almost inevitably, given the boom we've seen here recently. Mortgage rates are going back up. So anybody who's financed real estate kind of at the hilt, if you will, needs to have thought that through very, very carefully, because that could unwind on them pretty quickly. And then there's carrying the interest payment on it. If you have a situation where your lender's being so kind as to charge interest in the form of a bullet, which means you don't have to service it currently, you can get a little too optimistic. So you have to make sure that your income is sufficient to carry the interest on an ongoing basis and still give you plenty of room to live your life otherwise. Folks that really want to get out there over their skis, they can certainly do that. They just need to be aware that they're doing that. They need to have thought through the downside or the risk associated with that.
Okay. And talk to us a little bit about what some of those downsides and risks are, because there are many people that subscribe to the thought of, well, if it cash flows and it's a safe investment from a cash flow perspective, I can always afford to service that debt. And so the values going up and down doesn't really affect the ownership on a day-to-day basis. So curious to get your thoughts.
Well, I mean, that's a wonderful situation. They should be happy that they're in that situation to begin with. If you have a property where the rental income covers the expense of your debt and the expense of the upkeep of that real estate, more power to you. But there's a lot of folks that go beyond that level. If you had a nice portfolio of net income yielding properties, you've done well.
Great. And so where is it that people start to kind of get beyond and start to get themselves into trouble?
Well, I think now is one of those periods, that, maybe not to the extent that 2006 was, but, all of a sudden, everything I read is about how real estate values have gone up and are going to continue to go up. And that's when they stretch. That's when they start to say, well, if they're going to be going up at this rate, I can afford to buy a property where the rental income doesn't necessarily cover it, or is it right at the razor's edge of covering it? And so let me just leverage up and get a lot more property because I'm going to be covered by the subsequent appreciation of the property. And that's just kind of the cycle. I'm 66 years old, so this will be, I don't know which cycle this will be. This is like the fifth cycle. Real
You've
estate.
seen it all.
And you see folks who have their pencil out and their green eye shade out, and nevertheless they get a little bit overly enthusiastic and don't really calculate what might happen.
Yeah. And that makes a ton of sense. So it sounds like when folks start flirting with speculation, much more so than kind of sound investing principles from a cash flow perspective, that's when you can get really burned.
Yeah. I mean, if you're careful about what you can do, real estate is a great business. Real estate's the largest business in the United States. It's the oldest business in the United States. It's always going to be there. It's what makes the world go round, so to speak.
I was hoping you might say that.
Well, I mean, let's put it in perspective. There's about $35 trillion in private sector debt in the United States right this moment. About half that's real estate debt, about $16 trillion.
Wow.
All energy lending combined is about $1 trillion. All healthcare debt combined is maybe $1.5 trillion. Real estate is kind of the center of the universe and has been since this country was founded.
Oh my God. I had no idea it was so significant. And when you say private sector, I mean, does that include private businesses and corporations, or is that like everyday people like you and me get mortgages on homes to live in?
Simplistically, we just define that as households and businesses.
Okay. And you said 16 trillion, is that right?
Yep.
That's such a large number.
Well, let's talk about the Great Recession. In 2002, household mortgage debt, which is now 11 trillion, was 5 trillion. By the time you got to 2007, it was 10 trillion. So in less than 4 years, mortgage debt doubled. It had taken, 50 years to get from 0 to 5. It took 4.5 years to double from 5 to 10 trillion. And since that time, it's only grown to about 11 trillion. It actually declined some and has come back up. So, it's very, in retrospect to some, it was very obviously a runaway debt period. We're certainly not in that today, and I don't expect we will be, but it's something we keep our eye on.
Okay. And so what should your kind of average everyday investor do with that kind of information? Is that something that says, hey, let's kind of keep tabs on it and see if we're headed towards a recession? Do they need to be looking at such a macro level, or are they able to focus more so on kind of the micro with their local sphere of influence?
Well, they should spend most of their time focused on the micro. The macro is a very easy thing to keep tabs on. It'll take them 5 minutes a month if they want to do that. The information is is on the Federal Reserve website.
Okay.
They come out with fresh data quarterly. There's some folks that actually augment that monthly. It takes, and we keep charts that go back decades. And the most important thing is just aggregate real estate debt divided by GDP and seeing how that changes over time. For this past decade, that number's actually been very flat, which should give a real estate investor an enormous amount of confidence. It's starting to trickle up a little bit now, which should say to us that we should continue to be confident. Forgetting the dimension of rates for a moment.
Sure.
It's just talking about the level of activity. And but it's not hard to tell when there's a boom or a bust. It's not going to happen in a week or a month. It takes a year or 2 or 3, and you can see it coming a mile away through that simple exercise.
And so if someone goes and is tracking this and spending a couple of minutes a month, as the percentage, as real estate debt as a percentage of GDP goes up, that's where we start to need to get concerned. Is that what you're saying?
Yeah, and it not just a little bit. It needs to go up a bunch. It went up, like 20 or 30% in that period between 2000 and 2007. It wasn't like you had to get your microscope out.
It was obvious.
It was the hockey stick. So I can't see, I can see rates going up, putting effectively a curb on real estate activity right now. I cannot see runaway lending, which is an even bigger problem that we've seen in the 80s and we saw in the 2000s. I can't see that being an issue for a while, and I think that's a helpful fact.
Okay. And I'm so glad you mentioned that, Richard, because you segued so nicely into the question that I wanted to ask, which is, I think so many of us, especially in the last 2 to 3 to 4 years, who have gotten a mortgage, feel like we've gotten a full cavity search, from lenders. And so aren't they there and by law have to protect the consumer to a degree? I mean, they're looking at our debt to income, they're making sure we can afford these properties. And so isn't that a really great backstop to preventing that runaway lending?
Of all that Dodd-Frank did, and it was a gigantic bill, that's the single most useful thing that was contained in it. The very simple concept that the lender has to be able to demonstrate that the borrower has ability to repay, ATR. And yes, that has been I view it as probably the most valuable, maybe one of the very few valuable things about Dodd-Frank, but yes, it does.
Okay.
Now, that doesn't mean you can't get into other areas beyond real estate and get into trouble, but real estate at the moment. And by the way, it also would suggest to me that, clever people somewhere are going to figure a way out around that. So that, they're able to kind of sidestep. They haven't yet, but it's like in the credit card business right now. This is not real estate, but this is, people buying goods like computers and clothes and things like that. Well, they've come up with things that are different from lending. They talked about, that are kind of built into the purchase, so you can't even see that you're getting a loan. It's kind of a deferred payment plan. So that, sure enough, somebody's figuring out a kind of an end run here, and I'm sure that'll happen in real estate.
Yeah, I could definitely see that happening too. So talk to us a little bit about COVID and what you've seen the kind of average American household debt do as a result of COVID, because I think everyone had their predictions for the real estate market. Oh, no one's going to pay rent. It's going to come crashing down. Everyone who owns this real estate is in trouble. And really, we saw the opposite effect. So I think something we've heard less about is what your kind of household debt looked like as a result of COVID. So wondering if you have any insights there.
Yeah, we track that very carefully. And it has gone up a little bit, but not nearly as much as we would have guessed. I think in retrospect, what Congress did and what the Fed did was extraordinary. It was far beyond what I would have expected. We've gotten, in essence, $3 trillion of support, including $1,200 checks and $1,400 checks.
Mm-hmm.
And we've had markets, from municipal markets to certain portions of the real estate market being held up by Fed liquidity. So I was stunned and impressed by what Congress and the Fed did. For all their dysfunctionality in other areas, they came through like champs there. So I think that what they've done for that market has kept that market as healthy as you could have ever hoped. Now, a couple of other things. One of them is a lot of that mortgage forbearance and rental forbearance is just now ending.
Right.
So I don't think, everybody's optimistic. I've talked to the Fed regularly and others. Everybody's got all their fingers and toes crossed and thinks that while there's going to be issues with that, they aren't going to be nearly as widespread as we would have guessed a couple of years ago. But we don't know. We don't know how that's going to work its way out.
Why are they so optimistic, just out of curiosity? Because given those set of facts, if you told me, which I have heard, but people didn't make their mortgage payments for X amount of time, and now they're getting tacked on either to the end of the loan or they're kind of accruing. There's different ways of doing it. That just sounds like a situation ripe for a bunch of people losing their homes.
I've been trying to figure that out for a year and a half now. And, I think most banks, this is where I will speak a little bit about my current job, but, we spend a lot of time talking to folks about that. And the level of commitment by the lenders to successful outcomes is very high. So I can't speak for a given situation. I can't predict the future, but I do know that generally lenders are as motivated to avoid having to go through the very expensive and difficult process of foreclosure or eviction and things like that as anyone. So I hate to speak universally, but I certainly think that's the bias.
Okay. Well, I'm so glad to hear it, because I think a lot of folks would argue or have heard the opposite of the big bad bank wants to take my house back because then they could go sell it and make a profit. But what you're saying is, again, anecdotally, that's not been the case from your experience.
It's very expensive to a bank to go through that process. It's thousands of dollars for a bank to go through that process per home.
Say more on that, because I think that's a really interesting insight that people probably don't know much about.
I mean, I don't know what more to say other than I've never met a banker, and I'm sure they're out there. I've never met a banker who preferred eviction and foreclosure. They would much rather have a gentler outcome. I'm not those bankers. I'm not in charge of those policies.
Yeah.
So I can't speak to it. But as a general matter, in my career before I was in this position, I've never met folks that were inclined in that direction. I'm sure there's plenty of them out there. I'm sure there's plenty of problems that are going to occur, but the general bias that I'm familiar with is that folks, they view the cost of foreclosing on a home as being thousands upon thousands of dollars. And by the way, not just thousands upon thousands of dollars, hiring a huge staff to handle it, the process of going through the logistics, the staffing concerns are very, very high. So I'm not going to say there's not going to be trouble. It'd be crazy of me to say that, but But I think the tone that I hear out there is different than that.
Okay. Well, that's great to hear. That's great.
Now, I was going to make one other point, and that is the inventory levels of unsold houses is at an incredibly low level right now. You know, before, if we go back to 2002, 20 years ago, my recollection is the volume of unsold houses, I'm going to say, was 1.8 million.
Okay. Countrywide.
Countrywide. You know, the mortgage data that's released by the industry that we pick up. If you guys aren't looking at that data, you need to. This is like the Mortgage Banking Association and others. The inventory of unsold houses by the 07, 08, at a point when it was clear we had built way, way, way too many houses. It was 2.7 million.
Okay.
So you went from 1.8 to 2.7. Today, it's 1.3 million. It is the lowest it's ever been on a ratio basis. And that's really the issue. So you already had, everybody was still licking their wounds from the Great Recession. Inventory were being kept low by the caution of the industry. And then COVID hit, and for like half a year or more, you couldn't build houses because of the lockdown, right? You couldn't send an appraiser to that.
Right.
I remember that controversy in those early months. And so, what was already a problem was compounded by, so I personally think the biggest driver of the sustained high valuation of homes right now is the fact that we have such a low inventory going in. And that has to be a good fact for your listener.
That's a great fact. And so, and that probably compounded and is only exacerbated by low interest rates.
Without question.
Okay. And so how do you, and I'm going to ask you to break out your crystal ball here a little bit, but so how do you foresee things changing? Because inventory isn't going to change in the foreseeable future. I mean, you just physically can't build enough homes to meet demand. But so rising interest rates is the seemingly silver bullet, if you will, to kind of curtail this crazy demand. How do you see those two things? I mean, how do you square those two things?
Well, they're going in exactly the opposite direction. So you might just pretty easily come to a conclusion that it's going to be more of an equilibrium, in terms of valuations and so forth. I happen to believe, I spent a lot of time thinking about inflation. I think this inflation is not going to last more than, let's call it 2 years, unless we have another wave of COVID that's beyond what we expect. So, let's say we have somewhat higher mortgage rates for a couple of years. Then I would expect mortgage rates to abate again, because I think kind of the fundamental direction of economic activity is to a softer, slower level. Mm-hmm. So I think interest rates are going to go down. So I think I wouldn't be surprised to see things achieve something of a rough equilibrium over the next couple of years, and then get back on a positive path after that.
Okay. All right. Well, I'm keeping my eyes peeled. I know that. Richard, I want to shift gears here and go in a very different direction with you. And I'm curious to get your thoughts or recommendations for some of our younger listeners out there who are kind of just getting started, maybe out in their career. And we talked even on the episode today about good debt versus bad debt, and consumer debt and credit card debt is often so linked to the bad debt. But it seems like that's a necessity in order to go get good debt. And so what should people be doing to set themselves up for success in this country from a debt perspective? Well,
I think you make a wonderful point. I can remember the time my dad told me that, I was probably 14 years old or something like that. And I told him, I'm going to have the best credit record in the world because I'm never going to borrow for anything.
Right.
And he kind of laughed at me and said, well, you won't have any credit record whatsoever. If that's the case, you got to borrow some. So I think viewing it kind of the way you outline is the right way to view it, which is a limited use of credit that establishes that you're a responsible repayer of debt. Maybe an auto loan and one or two credit cards is more than sufficient.
Okay.
For that, and being very careful and responsible about those things, living within your means, will set you up very, very nicely, because the things that work against you in a credit score is having too many what are called trades. Every card or car or whatever you borrow against is called a trade. So if you had 10 credit cards and 2 automobile loans and a home loan and a vacation home loan, that would be what, 14 trades.
Mm-hmm.
And, having 14 trades works against you. Somebody that has 4 or 5 or 6 has, gets a benefit in their credit score, and somebody who has too many has a detriment. The other thing that works against you is borrowing too much of the line that you've been provided. So if you have a line of credit of $4,000 and you're borrowing $1,000 or $2,000 against it, that works in your favor. And if you're borrowing $3,900 against it, that works against you. Obviously, instances of delinquency and charge-off work against you quite heavily. So, having a few sources of credit and managing those responsibility will put you in good shape.
Okay. And any tips, tricks, tidbits, pieces of advice for folks to help repair their credit if they are thinking about wanting to qualify for a mortgage, for an investment property at some point down the road?
Yeah, I think most banks will work with you. I mean, it takes time to repair your credit, right? So, getting current, it's the things you would think intuitively. Getting current is the biggest single thing of all. Paying everything down may or may not help you that much. But if everything, if any part of your debt is delinquent, you're kind of out of luck. So having things being current, if you have a burden of too much debt, frankly, most banks will give you some kind of relief. If you work with their collection department, they'll give you relief in the form of a more favorable interest rate, or the elimination of interest rate, or in some cases even might reduce your principal or what have you. There are a lot of sleazy credit repair entities out there. They'll advertise on TV, and they'll charge you a fee to repair your credit. I think by and large, those are the ones to be avoided. There's a few that are not for profit that will help you, that genuinely are dedicated to the right thing. There's the one that comes to mind is an outfit called NFCC. It's not for profit. There's not a penny that drops to their bottom line. It's all their work is to help consumers. So I'd either work with the bank or with a not-for-profit like NFCC, and they'll get you on a plan that makes sense.
Okay. And if someone is finding themselves in trouble or trouble around the corner, it sounds like getting in touch with their lender proactively ahead of time is going to be a good move.
Absolutely.
Okay.
But it's not fun.
I was going to say, it doesn't sound like a fun conversation.
It's not fun, and altering your lifestyle to spend less is a complete not fun. But you kind of have to face up to it if you're in that situation.
Yeah. That makes total sense. Richard, this has been super informative. Really a lot of good stuff here. Any final thoughts for folks before I let you out of here?
Only that you guys are terrific, and your show is one that folks folks benefit from, and I'm impressed and glad that you're doing all this good work.
Thank you so much, Richard. Really appreciate it. If folks have additional questions for you, want to get in touch with you, learn more about you, where's the best place for them to do that?
Same place, richardvague.com, VAGUE.
Easy enough. Richard, thank you again. I look forward to staying in touch. We'll talk to you soon.
Thank you.
Alrighty, everyone, that was our episode. A big thank you to Richard for coming on. Super informative. I know I learned a ton about debt and the history of debt and just kind of the whole outlook of the real estate market going forward. As always, if you enjoyed the episode, please feel free to leave us a rating or review wherever it is you get your episodes, and we look forward to seeing you on the next one. Happy investing.